Hello friends, so today in this data-backed insight series that we have, we are going to study three different uh, index types. So market cap weighted Nifty 50 index, and we compare the performance of these and the issues that each of these have versus the other. Then of course you have the Nifty 50 equal weighted index, and you also have the Nifty top 10 equal weighted index. So these are top 10 free float market capitalization based stocks that create this 10 stock index, and these are all indices which are promoted by the index company, and so we will study how these indices stack up against each other. So Nifty 50, the normal Nifty 50 is normally weighted. uh, when we move from the normal weight to equal weights, what are we doing? We are essentially making the weights of all 50 stocks equal in the second one, and in the first one they were based on the relative market capitalizations of those stocks. So we are removing the weightage bias when we go from normal weight to equity weight, and then when we go from equal weight Nifty 50 to Nifty top 10 equal weight, then we are focusing only on the top 10 stocks of the Nifty universe. We've already removed the weightage bias, and now we are focusing on the top 10. But the assumption here is that the top 10 are the leaders of the market. They may be in terms of long-term market cap, of course, long-term leadership in the market. But for any given period, let's say 1 year, 2 year period, there may be a lot of these stocks which may not perform, and that will essentially trickle down to the performance of this Nifty top 10 equal weighted index as well. So let's think it through. Uh, is it logical or is it wise to ignore the bottom 40 stocks by just looking at the top 10 equal weights? Now, if we compare the Nifty 50 normal weight and the top 10 equal weighted portfolio, uh, what you will see here is that, for instance, in the normal Nifty, we have HDFC Bank Limited weight is 11%. In the Nifty top 2010 also, it is very near that at 9.93%. But in the regular Nifty, State Bank of India is 2 point, let's not take State Bank, let's take Larsen, for instance. So Larsen here is 3.73%, but in the top 10 equal weight, you see Larsen at 9.88%. Also, the biggest public bank of India, which is there in the Nifty 50, is not there in the Nifty top 10 equal weight. So many of the important stocks which represent the whole market also get taken out. In terms of total weights by the top 10 constituents in the Nifty regular index, you have 55% weights taken up by the top 10 stocks, whereas the Nifty top 10 equal weight uh, distributes that entire weight across 10 stocks. So, the total weight, of course, is 100. But the fact remains that in the second index, we are not really getting the benefit of other stocks which are performing beyond the top 10. So top 10 is essentially just looking at those larger market caps. So when we look at Nifty 50 versus Nifty equal weight versus Nifty top 10 equal weight. So this is what we see in the last 8+ years. We see that Nifty is the black line. So Nifty has returned 186% in this period. Nifty equal weight has returned 174%, slightly less than Nifty actually. And this is the scene over the last 8 years. But if we were to look at, let's say, the last 4 years or 5 years, you will find that equal weight has done phenomenally well, especially since 2023 March. You can see here since 2023 March, it has gone from 65 to 174, while Nifty 50 has gone from 102 to 186. So certainly the percentage gain on Nifty 50 equal weight recently has been phenomenal. If we now look at the blue line, which is the top 10 equal weight, it has performed really well all through, not just in the last phase of this market, but also the run up from 2016 till 2020. Just see the difference of top 10 portfolio in the first 4 years. Top 10 portfolio equal weight is 73%, Nifty is only 40%, and Nifty equal weight was actually flat, no returns for those 4 years. So this weightage business and the selection amongst Nifty can make a huge difference in terms of what is the outcome uh, of that index. In terms of the max drawdown now in Nifty, regular Nifty 50, you saw in these 8 years maximum drawdown of 38%. In the Nifty 50 top 10 equal weight, Nifty top 10 equal weight, we had a maximum drawdown again of nearly 38%. But in Nifty 50 equal weight, you had a drawdown of 48%. So the drawdown was much steeper in the equal weight across 50 stocks. The concern with Nifty top 10 equal weight is that ignoring the bottom 40 uh, is somewhere suggesting that you should always remain with these top 10 and ignore the bottom 40, whereas there will be periods where the bottom 40 will actually do very well while those top 10 are not doing so well. Uh, so the market cap based selection is probably not the best way to select stocks in your or select the index, or maybe select stocks in your portfolio. So again, should we ignore the bottom 40? And let's see the distribution of the last 1 year's performance, for instance. And this is as of 16th of October. So stocks 1 to 10, the top 10, the average yearly return is 30%, 11 to 20 is 38%, 21 to 30 is 58%, 31 to 40 is 80%, and 41 to 50 is 68%. Amazing kind of returns in the actually the bottom 60% of the market. Bottom 40%, 40 of stocks have delivered an average of 61%, whereas the top 10 has delivered an average of only 30%. So you can see that by not having the last 40, what kind of returns are we giving up? So what is the better way of doing this? The better way of doing this is to treat the stocks individually and add a momentum to the mix. So use a momentum strategy to run on Nifty stocks. And if you were to select, let's say, top 10 highest momentum score stocks, and you allocate 10% weight each, so there is no weightage bias also. How do you think that would stack up against the Nifty 50 based indices? So let's see that. So here is the result of this experiment when we run momentum top 10 equal weight stocks. So top 10 out of Nifty based on a momentum score versus Nifty 50 versus Nifty equal weight versus Nifty top 10 equal weight. So the orange line is the Nifty 50 equal weight, 183%. The black line is the Nifty 50, 195%. The blue line is 234%. That is a Nifty top 10 equal weight. And the green line is that of a momentum portfolio, which selects top 10 and goes to equal weight, 385%. So you can see the kind of outperformance momentum can do by using the same constituents, but by not having any bias towards market cap. So market cap bias leads to selecting very large stocks only, and those large stocks cannot keep performing all the time. So Nifty 50 has drawdown of 38% along with Nifty top 10, but Nifty 50 equal weight had a drawdown of 48%, and surprisingly, momentum top 10 equal weight has a drawdown of only 24.6%. So the result is an outcome of combining the two core pillars. One is momentum, the other is to have bias free weights, and when you put these two together, you can really hope to beat the index. This is a unheard of outcome by a lot of folks. So I hope that these series or this video will open your eyes towards momentum investing. You could design your own momentum investing strategy if you like, or you could use any of ours, and you will find that the ability of the momentum strategy to pick the winners, to pick the strength, actually helps in the long term in terms of getting out of losers quickly and not getting stuck with preconceived ideas of market caps or weights in general. Let me know how you like this video. Thank you so much. Bye bye.